from the traditional crypto markets, I guess they are now, to I think everyone's aware of the last 2 years and a bit of a frenzy we saw in 2017 when we decided we're going to tokenize the world. Anything that moved, we're going to tokenize it, everything, including your toaster. And look, that was again another good educational exercise. It brought in lots of attention. Some of it was a little bit misplaced, but I think we're actually seeing that, as the dust has settled down, there's actually some decent projects which are around. They've survived. Some of them have learned from others' mistakes, and I think it's forming a good foundation for what will come next in this space. So, it's not all bad. I think the obvious thing that came out of ICOs was pricing tokens. How do you price these tokens on these networks when they've not really proven their value yet? So it became quite obvious that the next move, I guess, was to say, well, equity, tokenizing equity, making smart equity is probably the way to go. And I think that's kind of the transition we're seeing. Again, not an easy thing to do. A couple of the guys touched on the last panel about regulations. I think Obi mentioned that if we're looking at securities tokens, then I think most places have said, well, if they're securities, they're securities. Slight nuances across different spaces, and which is fine. I think this is the first step, and things will evolve along the way. I don't think it's a bad thing to start out with things looking like the existing world, and then gradually strip down some of some of the weaknesses in the existing system and improve using the technology as we go forward. So I think we cover that space well on this panel. First up, I'll let you guys introduce yourselves as well. We have Gregory from CommerceBlock. We have Graham Rodford from Archax, Adam Vaziri, who's a very old-time friend of CoinScrum, from Blockpass. We have Dave Nicol from R3. If you just want to say a couple of words about your projects, and then I'll start asking some questions.
Yeah, so I represent CommerceBlock. We essentially build layer 2 solutions on top of Bitcoin, primarily around technology called sidechains.
I'm Graham Rodford, CEO and co-founder of Archax. We're setting up a regulated digital securities exchange in London.
Hi everyone, Adam Vaziri.
Sorry, use that one, Adam.
Adam Vaziri, CEO of Blockpass. We specialize in providing identity solutions for security tokens.
Hey there, my name is David Nicol. I work for R3, and we build and sell the blockchain for business called Corda.
Thank you. Okay. So, I mean, we were talking about infrastructure on the last panel, and actually to me, if we look at the projects you guys are working on, there actually seems to be a bit more clarity on the infrastructure that's being built, and what is potentially replacing in the old world, and what's essential in this new world. If anyone's familiar and been following the story of crypto for a few years, I guess it gets a bit tribal. You'll have your crypto purists who think that everything needs to be on public networks, and that's where everything will end up. You've had projects such as R3 looking at private enterprise solutions, whose founder, CTO, Richard Brown, he used to come to our meetups in a pub back in 2013, 2014.
We got him out of the pub.
You got him out of the pub.
Been a good thing.
I don't know, I think he still goes back into the pub more than you know. But should take that off camera. And actually, R3 and Corda's founding team were very much built from developers that had worked heavily on the public crypto space, specifically Bitcoin. They had a lot of awareness of that particular field, but they also recognized pragmatically that if this technology is going to be used for enterprise use cases in the near term and maybe longer term, that these new technologies were still way too raw to actually meet the needs. That's the approach that R3 have taken, you mentioned. But for Nicholas and your team, you're also looking at this infrastructure layer, but you're looking at public chains, also recognizing they don't meet all the needs and they can't do everything, but looking at how we can potentially have a hybrid solution for federated models which work as a side chain, as you say, but interact with a public blockchain. So that's kind of one layer where we're looking at token issuance and settlement. And then Graham, you're looking at starting out at the traditional exchange kind of space eventually, or a venue which is from the top down, rather than looking at how these things need to be regulated and how you potentially then interact with these other layers below of settlement and issuance. And then I think for Adam, the other critical one, for me, one of the main things in this space in general is around identity. Whether on these improvements on private networks or for existing enterprise, but on public networks as well. So, David, if we can talk about your approach, what you see, why you've taken this approach, what demand you're seeing for it, but also thinking about public networks as well, and what your view as a company would be around that.
Yeah, absolutely. And Paul, that was a really good intro. And I should say, we're hiring in both marketing and sales, if you're ever interested. Okay. You could work with Richard, which would be great. That's one of the best things about working at R3. No, so thank you for that. So absolutely, your story of how R3 and Corda came about is exactly that journey. We took the public blockchains, Ethereum, Bitcoin, and different variants, and we started applying those to lines of business operations in banks, in financial institutions, at trading venues, and tried to see what would happen if we all made it work together. And we just found that there were problems with scalability, problems with privacy, problems with data being distributed to the entire network, and it just was not fit for purpose for institutions that have risk officers, institutions that have compliance officers, and organizations that have some pretty robust regulations around what they install in their data centers and what kind of software they run. So that's really where Corda came from. And what we have done is both learn from the public communities and other blockchains out there to try to incorporate the best practices and all of the good things that this very exciting ride has brought us. Things like smart contracts, things like consensus of different kinds. I was just talking to Nick earlier about, he was saying, so what is Corda's consensus mechanism? And that's kind of the beauty, is that it's a pluggable consensus mechanism. We've allowed you to have transaction finality by ordering transactions with a trusted third party to validate and order transactions, or use something like proof of work or proof of stake periodically or constantly if that's what you'd like to do. So that's kind of where we come from, and we think there's massive opportunity in the capital markets writ large and in digital assets all over the place. And how do we think about public chains? I think that it's not that they're barking up the wrong tree, as you might have said, but there's a time and a place for everything, and I think that there will always be a market and a community for folks using Bitcoin or Ethereum applications. It just might not be the same types of volumes, the same types of applications, the same types of assets being traded as you see in institutions.
Okay, and Nick, I mean, on the other side then, you're stepping on similar ground but taking different approaches. Do you think you can achieve everything?
Very much so. I guess we kind of build a hybrid solution. So we've taken Bitcoin source code, which I don't see as a 10-year-old project. I see it as a project that's had 10 years of engineering. It's been battle tested, it's been hacked, it's been beaten up, and it's shown to be quite resilient. But we put it in a kind of like a private mode. So it's called what's known as a permissioned blockchain. So we run it as a side chain, and then we use a public network such as Bitcoin as its proof of work. For me, a blockchain without proof of work is essentially a database. And what I've seen, I've worked with clients. They've invested a lot of money, in things like Hyperledger, and they've basically said, well, I've essentially got a bad database. But I can't use Ethereum because if Ethereum forks, what happens? Does my token essentially become a stock split? And then you look at some of the issues that Bitcoin has had with high transaction fees. How do I protect myself? Well, we can use Bitcoin's proof of work to basically make your own blockchain an immutable store. And we basically have a side chain which basically is built on Bitcoin's Bitcoin source code, which is tested. By using Bitcoin, we can use the existing custodial solutions out there. We can use existing wallets, and we have some form of interoperability with existing exchanges. And that's the way we're looking at this. So.
Okay, I mean, Graham, so this is obviously relevant to you. You're focusing on the exchange layer, getting the regulation right, so that institutions can enter this market and start, exploring tokenized assets of all sorts, whether it's equity or what have you. But you're going to be the guys that are going to have to make a decision about what technology you support. And there's a risk of, we're already seeing a risk of fragmentation in the market, where if everyone's trying to solve the similar problems or the same problem, but bringing in new technologies which aren't interoperable, what's the risk for you as a company? Do you have to make these decisions now? Or is it, you're going into an experimentation phase? Will you be looking to support all sorts of technologies? How does that work?
Yeah, so I guess the place where this affects us mostly is on the issuance side. So obviously from a value chain perspective, you've got the companies that are the issuers, they create their security token, and they tend to choose whichever protocol they want to operate on, and then it would come to us as the secondary trading venue once it's gone past primary issuance. From our point of view, that everyone's working on the same standards, everyone's looking at the same common goals, cross-border regulation, whitelisting, restrictions on trading from jurisdictions in initial periods or on an ongoing basis, and also dealing with all sorts of corporate actions. The problem is everyone has their preference, and you touched on it at the start, whether it be a public blockchain, a private permissioned blockchain, whether it be a side chain. Everyone's got their preference. And it's impossible to know who's going to be right or wrong over the long term and where it's going to play out. So what we're doing at the moment is we're just looking to work out which ones are almost on our preferred list, the ones that are well tested. Ethereum has definitely got its critics, but it seems to be getting the most traction at the moment, probably because there's a lot of ICO advisory firms who create tokens in that space flipping over to this space. So unfortunately, whether or not you believe it's the right token, you probably have to embrace it. So what we're doing at the moment is just working through them all, making sure they've all been well considered, but really ensuring that the issuer behind them is well placed to understand that if necessary, they can burn and recreate the tokens on another protocol later.
And I mean, that carries a reputational risk. I mean, these are tough decisions to make in these very early days as well, because if you make a decision and you're reliant on possibly a new technology built by a relatively young team. And so I guess, when you're looking at enterprise solutions that might be extremely well funded with big teams, that's going to be kind of form part of your decision-making process, I guess.
Yeah, you're absolutely right. So, we know the guys at R3 well. We like the Corda approach. It's obviously institutional. A bunch of the banks are backing it. So from our point of view, if we were to record all of our transactions on a ledger, we'd probably opt for something like Corda for a private permissioned blockchain, and so too would probably institutions trading on our platform. But it's hard for us to dictate to issuers how they would rather set up their security token. And a lot of them are, like you said earlier, Bitcoin maximalists. They want it on a public blockchain. They want it to be fully transparent. And if they approach us with a good quality issuance on a public blockchain, then we wouldn't turn it away. And what's important is to understand. You've got guys like Securitize, Tokeny, Navora Globacap here in London who do a really good job of trying to develop their platform, follow regulation. And I think if you understand the primary issuance platforms and you make sure you do your due diligence on them, you can get a level of comfort. And then when issuers come to you, make sure when the issuers themselves come to you, make sure the primary issuance platform they're using is one that you know, but also make sure they've had appropriate code audits or the like.
Okay. So Adam, I mean, you've travelled some miles around the globe the last few years, constantly on a plane. Specifically, you've looked at regulation very closely, and I guess this is kind of, I remember you telling me that you were looking at various projects, and the common problem for other projects was around KYC and identity, which is a common theme, which led you to launch Blockpass. So how do you tie all this together? How do you bring this together for these other three on the panel? Because it's relevant to, I think there's any financial institution would love to bring down the cost centers for KYC processes, onboarding processes. We've all kind of signed up for bank accounts and just repeated that process time and time again. So there's relevance here, beyond. I mean, your solution isn't specifically a blockchain. Well, maybe you can elaborate on that a bit more, and how that all works, how this brings this all together, how it solves problems for existing financial institutions, how it's going to take this forward in general.
Yeah, I mean, I think the first problem is that in the existing financial world as we know it, we have a very outdated mode of compliance. It means that when I sign up with HSBC, I need to send my data to them. When I sign up with Santander, I need to send my data to them, even though I've got two accounts, they're doing two verifications. It's a duplication of processes and resources and wasting my time in me just wanting to consume the service. So what Blockpass does, and what is basically a very simple thing, which is to give the identity to the user. By the user having control over their identity, and by them getting verified first, before they even connect with a bank or any kind of regulated entity, they are verified to a certain standard. So they click a button, they can send their verified profile instantaneously on board. Now, if you take that logic and now that's being applied, this is the shift really from a merchant-centric, bank-centric environment and ecosystem to a user-centric ecosystem where the user in control of their data and control of the access that they want to have. When you end up in that situation, then the world is your oyster. And so if you combine that with security tokens, which is about giving direct access to people, it's not about just creating, lowering the administrative burden for managing securities. Yes, that is fantastic, but really the thrust of it is getting to financial access. That anyone, if I go to IBM's website, I can click a button and access some of their shares. If I want to sell it, I can just press a button and sell their shares. Most people probably in this room don't have an account with a broker. Raise your hand if you have an account with a broker. Okay, you guys like trading?
Crypto.
I would say a crypto broker or a broker for shares. Raise your hands if you've got a broker account to buy shares. Okay, you guys are traders. Okay, I would argue that most people in this room don't trade a lot of shares on a regular basis. And the access to assets and in a general way, there's many barriers to that. And to break down those barriers, you need to verify identities. And if you introduce security tokens in a silo, then you're just reintroducing those barriers. So the only real way of breaking down those barriers is to give the user control over their identity and to be able to connect to any asset that they want. And the asset itself has its own identity. So the asset is a registered asset. For example, an IBM share, it is a registered asset. It has certain conditions, controls associated with it, and I can interact directly with it, but it needs to verify me. And it can do that by me already being verified. And when you can do that type of transaction, data transaction, then you really open up the ecosystem.
Sure. It seems like an obvious example where you can start bringing down existing cost centers. At present, though, you could argue, we've got these new technology solutions which look very efficient, they look streamlined, opens up new issues around security, custody. All of these assets have a private key which control them, so there's a custody issue there. But as we have regulators come in and say, well, if you're issuing security, then it's a security, you've got to conform with all the existing regulations, fill out all the exact same forms and carry the same costs. Are there immediate cost benefits now? Graham, when you launch, is it going to be cheaper to issue a security through Archax than if I go to the Ames market or Next or something in London as a small cap stock and issue there? Are there going to be cost savings now? And if not now, how will they kind of evolve over time and kind of actually deliver something that's not that's actually offering the benefit there?
Sure. So I guess the jury's out on the immediate issuance. So I think it's worth just touching on some of the advantages of security tokens themselves, as opposed to crypto, which are bearer assets, in that they've got two mechanisms built into them which help their security. So one is that most of the primary issuance platforms into the smart contracts themselves are building whitelists to restrict their transactions. So that, for example, if someone were using Blockpass and you had valid accredited investors, they might be allowed to transfer a security, whereas anyone that wasn't validated wouldn't be allowed to hold the security. So that helps prevent them being transferred out of the ecosystem and stay in the walled garden. And the second thing is that all of them have to be transacted, for the most part, on regulated security markets globally. So you pretty much know every participant, and everyone is somewhat of a trusted actor in the space. And in theory, if anyone was to hack the security tokens, then they can be burnt and reissued. So that's a really critical point about the security tokens. So I think there are some attractions to doing a security token. The initial issuance now, I'd say, it's probably more expensive than Next, probably cheaper than AIM, because you've got a number of counterparties to consider. You've got the token creation, you've got the distribution. They're not being distributed out of the traditional investment banking model. It tends to be from advisory firms, and also then you've got the code audit, then you've got listing fees on ours, and then most people haven't established perform corporate actions and the ongoing maintenance of securities at the moment. But over time, there's no doubt they will come down. But I don't just think it's the initial issuance price that's important here. I think when you look at the benefits of security tokens, then it can be a lot cheaper on an ongoing basis. So for example, if you look at a dividend from a traditional equity, it would be quite a task to do that on more than a semi-annual basis. So you have to collate all of the investors held at the shareholder registry at any point in time. You have to get the total amount that's being distributed. You have your cut-off date. You distribute it to everyone's preference, and then you send it out to their bank accounts. Whereas if you know all of the holders at any point in time in a security token, as you should, then you can immediately pay dividends on practically a real-time basis out to all of the wallets. Obviously we need digital cash to start becoming a bit more prevalent in the space to be able to do that, but that's an example of where things can start getting a lot more efficient in security tokens.
But with that, sorry, Adam, did you want to say something?
Yeah, I just want to add a point about what the cost benefit may be for issuers. People talk about the United States as a market for security tokens. Really, the real market for security tokens for smaller companies is Europe. Because in Europe, surprisingly, the regulations are fairly pragmatic. If you want to sell shares directly to the general public, as long as you're not raising more than 2 million euros, which if you're a small company and you're just starting out, you probably don't need to raise more than that, you don't need to have your prospectus approved. And you can go ahead and issue your shares to the general public. Now, if you go through a crowdfunding platform, the crowdfunding platform needs to have a license for arranging deals and investments. So the only way of you accessing directly the market now at the moment is going through crowdfunding platforms. But the security token market, like the ICO market, is a self-starter market. So if I know how to code, I'm technically versed, so to speak. I can launch a smart contract. I can sell directly to the public under the prospectus directive. As a director of the firm, I am not needing to get a license to arrange deals and investments. So I can have direct access and a direct contact with my potential customers. So if you look at the Monzo model, or one of these challenger banks, they go and do a crowd fund. Why? Because those are their potential customers and they're the early adopters. In the same mind, for an early issuance of equity tokens, it could be the same model, but direct access into the market. And only in Europe you can do that to the same degree. In other markets, Hong Kong, I live in Hong Kong, no, you definitely can't do that. It'll only be for professional investors. In the US, Reg D, Reg A, that's going to be expensive. But Europe is a very interesting market.
Because obviously there's been a lot of interest and noise about this, but I just want to see if we can get some clarity of exactly where we're at. So we've spoken about primary issuance, which is when the original shares are being issued and sold to investors for capital raising for those firms. And then a lot of the talk, especially even during the ICO frenzy, when the SEC in particular started looking into this market, they were looking at the crypto exchanges. They were quite happy for them to carry on offering trading in the primary cryptocurrencies, but anything they thought that might look like a security, they were saying, well, you need to be a regulated secondary market effectively. And you saw some of the exchanges rapidly delisting some of these tokens, which they thought could be construed as a security. So we're seeing, I think, you guys mentioned primary issuance, some other people like Global Cap here in London. That looks like that market's being addressed. Where are we actually at in terms of a viable secondary market? Is there anyone regulated to do this? So I don't think any of the existing crypto exchanges are. David, where are you at with this? You're working with some partners, I know, in Switzerland with 6 Exchange. Can anyone actually trade these things yet?
Yeah, our good friends in Switzerland are one example. Swiss Digital Exchange, or Six Digital Exchange rather. They're building a legacy exchange, which is now moving entirely to the digital realm, so that they can list both existing securities, existing financial instruments, structured products, shares, equity, bonds, whatever, on this new exchange, as well as crypto assets. So to be frank with you, you can't go to the SDX and get an account today and start trading, but you will be able to do that shortly. I think you asked where are we with all of this. I think people are now starting to understand where the benefits are, and I agree with most of the other guys here on the panel that that you really have to get down to where's the real business value in security tokens. It's not that by issuing a security token you will immediately reach a more liquid market. A liquid market is brought by buyers and sellers, not by some new financial instrument. But I think that a lot of the benefit is in the life of the asset, the whole life cycle of the asset, allowing the asset to pack more data into the asset itself, allowing the regulator to regulate the asset itself rather than the asset holder, and then allowing the asset to respond to outside influences for things like splits, corporate actions, whatever it is we're talking about. So I think where we are right now is that we're taking all the lessons from what was a very explosive and very unstructured advancement in frankly the Ethereum world, and we're now figuring out how do we use those tools in something that institutions in real volume can actually jump into. Yeah.
And I guess just to add to that, and not wishing to support another exchange too much, but what SIX are doing is quite interesting for a number of reasons. So firstly, they're an established player backed by their members, so you know that they've got sign-off to do this by a significant number of banks. Secondly, they're already in the space. So they're in the space and they're embracing it. So why are they doing that? Because they genuinely see this as the future. So they've publicly come out and said SDX will replace SIX in the future. That everything that's currently traded will be moving to the blockchain. And the reason that they've done that is because they've already done the analysis and seen that not only is it beneficial from an efficiency point of view, but it cuts their costs dramatically. So that's the reason that they're making such an investment in these guys. They're not just looking to create a venue that you can trade security tokens on, they're looking at changing the whole rails so that not only can you trade it, you can settle it, you can transfer to a CSD. I mean, it is actually quite a fascinating project.
And so that idea, I mean, for this really to become valuable in the future, and if you're kind of going to replace some of the existing kind of required entities in that mix, say a CSD, you know, how closely are different exchanges going to have to start working together, either near term or long term? Because ultimately this becomes super efficient if you have, you know, your competitors, you're interacting with your competitors.
Yeah, I think a lot of this is about education, and I think it's just educating the whole infrastructure. So if you're influencing CSDs, clearinghouses, regulators, then you really all need to work together and form working groups. So I think, you know, SIX themselves have a CSD, so they have an advantage over a lot of others in the place. But you know, by working together, working on interoperability, then you can start to look how these assets transfer freely across the market. If you're just working on your own ecosystem, really it's no benefit. But if you know, we're speaking to SIX at the moment, there's T0 in the US, there's a few other ATSs, and at the point where you can all agree on the standards that you will transfer these between each other, then you really start to create that global market.
Sure. And Nick, with your technology, what else? I mean, we're talking about...
I mean, I guess we're focusing more on enabling people to trade peer-to-peer. You know, if we're just talking about getting, in my opinion, different regulated entities talking to each other, we can do that right now, you know, with shared databases. I mean, I'm from a traditional finance background. It was an existing regulation and maybe, you know, bureaucracy that stopped that happening. So a lot of the work we're focused on is more on commodities side, but we want it to be able to trade peer-to-peer. So if we need appropriate KYC procedures, AML, we build that into the blockchain. If we have scalability issues, we address that in the blockchain. But we don't necessarily have a shared blockchain where everyone can jump in, because that will hit scalability issues. The requirements of, say, a CoinScrum STO versus an IBM STO are a bit different. But that's why we build custom blockchains for, well, eventually you'll get there. Yeah. But yeah, we build custom blockchains, but then we use existing KYC procedures that, you know, we'd be happy to speak to Blockpass afterwards, and we use Bitcoin's proof of work to make sure that, you know, nothing hunky-dory can go, nothing can, you know, history can be preserved. We have immutability.
So in terms of your business development, though, I mean, obviously we're talking about specifically equity securities here, but you know, it's applicable for all of the guys really, different asset classes as well. So what are you seeing in terms of demand or interest just outside of like equity issuance?
Well, we came from commodities, so our first clients were very much in the precious metal space, and recently this year with the hype in STOs, we've had those kind of clients. We don't really touch the regulation. We either partner with people that have got existing licenses like crowdfunding, or, you know, we're talking to a few exchanges as well, but we provide the infrastructure, so the issuer of that equity would essentially own the blockchain, and that essentially minimizes your trust levels, so they're not reliant on a third party to kind of manage their assets.
So, from my point of view at least, if you're going to have a security token or issue one, you're expecting some liquidity. I think oh, the administration costs are going to be reduced, yeah, great, but we want liquidity, because this should be better than crowdfunding. If I go to Cedars and I invest in something, great, but there's never going to be a cash out event, maybe 1 out of 100. I want to pay my bills, I can't. I want some liquidity. And by offering liquidity, it means that consumers, to a certain degree, have markets where they didn't have before. They can support the projects that they love, but also they can pay their bills or potentially pay their bills. Now, we know about, the crypto market is an extremely, it's quite liquid, let's say, market. I can take Bitcoin here, I can throw it over there, I can trade it here, trade it left, right, center, and that infrastructure is growing. If we can leverage that infrastructure, and especially decentralized trading, like when they 0x introduced their protocol, and then you ended up with like 20 decentralized exchanges, it's about 100 million in volume running through 0x at some point in time. I want to see that type of infrastructure supporting security tokens eventually, but it will take some time, obviously, to get there. And one of the crucial problems at the moment is technical standards. So everyone is coming out with a new standard of how to issue a security token. There are various parties, there's like 30 parties. And so what I've initiated with British Standards Institution is to create an abstract, generic standard, technical standard around security tokens, which is a taxonomy, that you can take that taxonomy and you can apply it to any implementation, whether it's on Ethereum, Bitcoin, or whatever, and you can see and correlate the two. And so if you're an exchange, you can say, oh, where are you in that grid? Are you in that grid? I know what features and functions are available for that, so I can integrate it very easily. Technical standardization is needed in order to open up the possibility of liquidity, whether it be decentralized forms or even centralized forms.
I just add something, Paul, on liquidity. I think a lot of what's exciting about this space is taking assets that previously weren't tradable and tokenizing them. And there's no doubt for those assets that you're creating liquidity in what was otherwise a liquid asset. But the truth is they'll trade thinly and they probably won't have much liquidity at all. But you can, obviously what we're banking on is that traditional securities are also going to tokenize. And it's in those spaces that market makers are interested to participate. So I think you'll start seeing blue chip companies tokenize. You'll start seeing more tokenized equities like the X Exchange are doing at the minute out of Estonia. You'll start to see that become more of a prevalent thing before they're initially issued on the blockchain. So all we can be certain of, I think, at the lower end is that there'll be more liquidity than there is right now. And it doesn't have to always be a central limit order book as well. I think that's key. For some assets like property, then a quarterly auction might be a more liquid market and a more appropriate market for price discovery. And I think understanding the correct market for different assets as you move up the liquidity scale is important.
Okay. I mean, so we've got kind of two conflicting opinions slightly, I guess, at each end of the panel here, because, Nick, you've been saying you think, knocking on the door of regulators and trying to make everything fit there, where the other approach, again, which is a completely valid argument as well, is that we need to start off with things looking like the real world. But if we look at how the markets have evolved out of this retail space, there's been very little regulation. I guess there's an argument that things have become over-regulated anyway, and people don't actually know how to manage their risk or don't need to manage risk anymore because they've always got someone to turn to. Now, in the last 7 or 8 years, if anyone's trading on a crypto exchange, they know full well the risk they're taking is that whatever they put there, they might never see again. In many cases, they never did see it again. But also, there was no one for them to turn to, and they just kind of accepted it. Is there actually an argument that people actually need to understand the risks, and we're going to see the real innovation happen on the open networks? I mean, if we, again, not obvious comparisons being over the time that during the evolution of the web in general, we started out with all these walled gardens, we had our AOL, making sure you had nice little websites to see, and you had intranets and extranets, and eventually all those walls fell down and it just all went public. So, is the real innovation still going to happen out on these crazy networks, and do we just let like the crazy kids out there who are a lot younger than me just get on with it? They'll lose some money along the way, and we'll fix things eventually. Which way do we see it going? From which way is it going to happen out there?
The guy launching the exchange hands the mic over. Great question. No, so I think that there will always be innovation in ecosystems like the ones that you're talking about. It's a great place to experiment. It's a great place to, what did you say? There's so much to do around education. People need to understand what it's like. What does direct custody actually mean? Let's talk about the nature of custody. And thank you guys for sticking around as they close up the rest of the shop, by the way. But no, like understanding the nature of custody, understanding the nature of an asset lifecycle all the way through the process. I think there's a lot to be said about how the public markets have done that. Now, you then go to, real volume, the real buy side, the asset managers of the world, the pension managers of the world, and you say, right, there's this new thing, but you have to, each individual customer has to do direct custody, and they're like, whoa, these people don't want to know and don't know what an equity is or what a share split is. They just want me to manage their pension and make sure that they can retire on time. And you're like, oh, okay, right. There's also a place, I think, for this to kind of graduate up a scale to a place where there are, dare I say, middlemen who manage a lot of this complexity for end customers who have a real business need to see a number go up and to see a retirement account grow. So not to throw cold water on it, but yeah, I think there's definitely a place for both.
Okay.
Yeah, I mean, I think what I am excited about is that there is enough momentum in security tokens where we can take all of the crazy innovation that's happened and combine that in a kind of a regulated environment. And that's really a really exciting thing because, okay, like for me, cryptocurrency, they are bearer assets, you transfer them, it's a free market out there. If you lose your crypto, you're done. But when you enter into a security token space, these are registered assets. That's the first distinction. So you have to combine those assets with identity, but you don't want to create restrictions. As soon as you start to recreate, all of the previous legacy stuff, then you actually undermine the value of it. So you really want to see that cutting edge innovation at that edge of peer-to-peer markets, but with registered assets and providing greater access, faster trading, and more liquidity in edges of the market you wouldn't even see it before. I don't know anyone in crowdfunding that has much liquidity. So that's a very retail focus, but you're right, David. I mean, I don't think these things are mutually exclusive, to be honest. I mean, innovation in institutional market, you're talking about trillions of dollars, but for the retail market, we're talking about billions of people. But they're not, it's not mutually exclusive. So providing better access in this area is where I see great innovation and the ethos behind Bitcoin, which is about user access to financial services and optionality. That's what we want to see, but some variants on that model, not just the hardcore crypto, but some variants. I want to have stock in a company that I want to have, and I want to transfer it when I want to transfer it. I want to have control in the same way that crypto offers, but give me something that's regulated, that's somewhat controlled.
Guys, do you have something? Because I'm going to hand over to the audience in a sec. Have you got anything thoughts on that in terms of where it's all going to happen from? It's going to happen, a bit of both.
I think, I just agree with the guys, really. It's just, I think there's a lot of innovation in the space. We talked about SIX, they're super institutional. They're definitely innovating. SocGen the other day released their 100 million covered bond on the blockchain. They're institutional, they're innovating. I think they're absolutely mixed, and as long as people in the regulated space make sure, it's operate right at the coalface, but make sure it's within the realms of regulation, then I think you'll see a lot of innovation from institutions.
Cool. Nick, anything?
Yeah, just going on your point, I mean, I just think it takes a while for the software to evolve to the regulation. I mean, a few years ago, you wouldn't have thought you could have a KYC or whitelist in a public blockchain. Now we're seeing that, and we're looking at the existing regulation and kind of evolving the open source standards, the open source software to evolve to that. So it's not totally going, zero hedge.
I remember a few people used to mention it on Reddit and used to get kind of blocked and just shouted down somewhat if you mentioned blacklisting or whitelisting, but reality bites, I guess. There's drinks being served somewhere, so we need to get to them. Guys, any questions from the audience? Nicola. So the question was, are central banks going to get involved in terms of how they're going to issue their own cryptocurrencies or digital currencies?
I mean, I've always felt that Bitcoin was the biggest threat to central banks rather than your local banks, rather your existing banks. So probably absolutely not.
So I think, yes, you probably will see one. I think the UK were working on the Royal Mint coin not so long ago, and when Carney came out and said that we're not looking at this at all, made me think, well, that means you're absolutely considering this. So I think, when this all becomes exciting, real-time settlement and real peer-to-peer is when you've got a currency that's digital that everyone trusts. If you were to issue a government-backed UK, well, maybe not UK right now, but if you were to issue a government-backed UK coin usually, and everyone was to say, right, this is replacing Tether, for example, in the crypto world, then everyone would flock to it as it's government-backed. And once you've got a coin like that, you can start doing genuine real-time settlement and transfer between anyone really, peer to peer. So I think it will happen. I'm less familiar with the economics benefits, but there's definitely benefits of being able to understand your supplier, control your supplier, look at where your currency is custodied at any point in time as well.
I think there's a reason why central banks probably wouldn't do it, and that would be to undermine the banking system itself. Because what do you need banks for afterwards? They're not going to. You don't need to open an account with a bank when you've got the account with the central bank. So user-controlled central bank money is quite a macroeconomic issue. If it's only issued to banks, then yeah, it's great for interbank settlement. Again, an institutional problem that you're solving. But I think digital money, for example, in China, where I partially live, I can see that easily, the People's Republic of China issuing a coin, the renminbi coin, which is centrally controlled by WeChat. So a kind of fintech approach to central bank money provided through a technology platform, but precisely for that purpose. I could see that certainly happen in the near term, but it certainly won't be some decentralized currency that you can transfer to Bitfinex and trade.
Yeah, I'll be really brief, but I'll say that central banks are definitely moving toward this, and I can say with certainty that you'll see some kind of access to central bank ledgers through distributed ledgers, right? As more assets are traded on these systems, they'll need to satisfy the needs of those who need to settle, right? And everyone, once you reach a certain volume, a certain number, you need to settle in central bank money, and that's exactly the type of customer that a central bank wants to serve. It will probably be through the existing clearing banks, but exactly how that access is opened up is more a political question, and one that will differ jurisdiction by jurisdiction. And that last point's important, that it will be kind of jurisdictionally controlled, and it must be jurisdictionally controlled.
Cool, thanks guys. Any more? Another question? Do we have a couple more because we're getting short on time?
How about derivatives and the sort of structuring, I guess, of securities, digital securities to meet certain requirements of, say, insurers around that use swaps for managing the capital position?
Yeah, the question was, what about derivatives I assume you're talking derivatives on blockchain systems in general. The answer is that, yeah, that's like the ideal use case, right? The fact that you can pair a digital asset with with a smart contract, really just a bit of code that says that if this, then that, is a huge asset, and it means that you can construct different types of derivatives and actually understand what's inside a very complicated security, right? So everyone's talking about essentially digitizing assets. It's really just securitization in a new form. And I think that's the biggest benefit, that you can actually understand what derivatives contain, what different assets contain. I think it's a huge step forward.
Oscar, did you have a question?
Thanks. Yeah. So there's a technology being developed at the moment called Tari, which is a sidechain of Monero based on Nimblewimble. And it's a deeply privacy-focused technology, but their use case is for enterprise, commercial, tokenization, all that stuff. Do you have any opinion on the future of deep privacy mixed with the securities world?
For me, I think that is the most exciting space because if you think about it, no one wants to transact on a public ledger when everyone can see what you're doing. I mean, it's just an anathema to any sense of privacy. And with GDPR, again, an innovation of Europe, it's a shame we're leaving. With GDPR, it's now, you're taking a human right, which is the right to privacy, and you're actually rendering it in a legal form. And so it will be your right to maintain your privacy when you transact. But how do you maintain your privacy and not encourage money laundering? So how do you address this kind of juxtaposed, somewhat competing objectives? One is not to promote criminality, but on the other hand, to ensure the privacy of your citizens. And I don't think, again, these things are mutually exclusive. You can compromise between the systems. And in fact, we're cooperating with Beam, which is a Mimblewimble implementation, to see how you could have a totally anonymous system, but within it, a kernel of compliance. for those that want to have that optionality. And it's possible. I mean, to a large extent, you could say R3 is a Mimblewimble implementation. It's, you know, it has anonymity in it, but in a different manner, of course. So there's a concern about privacy, of course, in sensible blockchain implementations.
Thank you, guys. We're short on time. We've gone over time. Just like to say thank you again to our second panel. Thank you for participating today. Thank you again to Tiggy for her wonderful organisation of the whole event as well. Hear it for Tiggy. And if you're not aware of, if you weren't aware of CoinScrum beforehand, we hold monthly meetup events in Finsbury Square at Monzo's offices.